The myth? Everyone's piling into ETFs, and that makes stock markets less efficient. The argument? The more people invest through indexes and ETFs, the fewer people there are scrutinizing the fundamentals of stock prices to figure out if stocks are cheap or expensive. That must make it easier to pick stocks, right? It's a catchy idea that sounds reasonable, except it's completely wrong. In an earlier video, I explained that there are more analysts than ever following fewer stocks than ever, which is the first argument against this myth. But I'd like to take the myth to task even further. To fully understand why this myth is wrong, we need to look at what's known as the arithmetic of active management. This is a concept that William Sharpe described in the 60s, and for which he won a Nobel Prize. William Sharpe stated two fundamental truths about investing and markets. 1. Before costs, the return on the average actively managed dollar will equal the return on the average passively managed dollar. And 2, after costs, the return on the average actively managed dollar will be less than the return on the average passively managed dollar. The first statement essentially says that for every winner in the stock market, there must be an equivalent loser. Since index investors by definition get the market return, that means for every winning active manager, there must be a losing active manager. The return on all active funds as a group will match the return on passive funds. Because active funds charge higher fees, they must, as a group, underperform passive funds on average. For confirmation of this fact, look no further than the annual Standard & Poor's Active versus Passive report. It shows that the vast majority of actively managed funds underperform the equivalent passive funds over time. What does this mean for the myth we're trying to bust today? As more and more investors are moving to passive investing, it does mean that there are fewer active investors in the market. But which side do you think is shrinking? Is it the winning active managers or the losing active managers that are switching to index funds? The argument follows that it's investors who have not beat the market because of either bad luck or high fees or lack of skill, that those investors are switching to index investors. This leaves more of the winning or best active managers to fight it out. This raises the bar. It makes market more efficient, not less. I hope this has given you a new way to think about how the market's evolving and a deeper understanding of how index investing is affecting the market. As always, I'd love to hear your thoughts, so please leave me a comment below. Thanks for watching.